morning. This is lecture 1, week 9. This is the second lecture for topic 5. Okay, in topic 5, you have learned about how to do financial statement analysis. You have learned about the purpose of doing financial statement analysis. Just to refresh your memory, people do financial statement analysis with two purposes. The first one is for prognostic. The first one is for diagnostic, and the second one is for prognostic. Diagnostic means you want to people do financial statement analysis to identify problems that happen in a business. Prognostic means people do financial statement analysis to predict the future of a business. Okay, you can read about that in the lecture notes, and also you can watch previous lecture. And then in this topic, you have learned 3 methods that can be used to do financial statement analysis. Actually, there are many methods that can be used, but in this course, you have to learn only 3 methods. The first one is vertical analysis. The second one is horizontal analysis, and this is the third method. This method is called financial ratio analysis. Okay. Ratio is something that you have learned in mathematics. Ratio is the percentage or portion of something compared to another thing. Okay, so there are many ratios that can be used to analyze financial statement. I think if you check finance textbook, there are hundreds of ratios. But in this course, you will learn about only 5 basic ratios that can be used to analyze financial statement. Okay, the first ratio is called the debt ratio. Debt ratio is a measure of leverage, and it is related to debts. This ratio indicates the extent of borrowed money is used to grow the company and leverage owners' equity. As a general rule, all companies should have debt ratio around 50%. Okay, this is the formula to calculate debt ratio. The formula is total liabilities over total assets. So let's say the thing is like this. Let's say you see a business, and that business has produced a financial statement for year 2019. So you want to make a decision. Let's say you are an investor. You want to make investment decision. So before you know that before you can do a good investment decision, you have to analyze the financial statement first. So you know that there are many methods. Let's say you use this method, the ratio methods. So if you use the ratio method, this is the way to analyze the financial statement. One of the ratio that you can use is the debt ratio. Debt ratio measure the leverage. So how to do or calculate the debt ratio? To calculate the debt ratio, you have to use this formula, total liabilities over total assets. So how to get the data? How to get the number for total liabilities and total assets? You have to see the balance sheet of the business. So you take the number from the balance sheet, and then you can calculate. So see here. Let's say you see the small yellow box. Business A debt ratio. Let's say you calculate the debt ratio. Business A debt ratio is 35% and business B is 28%. So now, which company is better in terms of debt? In terms of debt. So, in this example, for this ratio, the lower the ratio, the better the business or company in terms of debt. So, if you compare two companies, business A and business B, the lower the debt ratio, the better the business. So, business B is better in terms of debt compared to business A. When you want to analyze a business, you can compare one business to another business, or you can compare current year ratio compared to previous year ratio to check whether the business is getting better or getting worse. Or you can compare one company or business ratio with industry average. Industry average is something like this. Let's say in Malaysia we have let's say we have 5 telecommunication companies, Celcom, DG, Time, Nexus, and I think there is another one. So we have 5. So market average is the average ratio of these 5 companies. Let's say you want to analyze Celcom financial statement. So you calculate the debt ratio for Celcom only, and you compare to the average of debt ratio of these 5 telecommunication companies. So after that you can make a conclusion whether Celcom is good or not. So let's say the average debt ratio for the 5 telecommunication companies in Malaysia is 35%. Celcom debt ratio is 30%. So you can say that Celcom is better in terms of debt compared to the market. So it is good. But if the market is 35%, the market debt ratio is 35%, but Celcom debt ratio is 40%, then you can make a conclusion that say Celcom is not good in terms of debt compared to the industry average or market average. Okay, that is one ratio. This ratio can be used to analyze a business in terms of debt or leverage only. So another point that you have to know is, as a see the point number 3 in this slide. As a general rule, all companies should have a debt ratio around 50%. So the general rule for the debt ratio is like this. If the debt ratio is 50% and below, then we still can say a business is okay. But if a business debt ratio is more than 50%, then it shows that the company is not good in terms of debt. Let's say your calculation is like this. Company C, the debt ratio is 52%. Company D, the debt ratio is 40%. So which one is better or good in terms of debt? Company D is better because company D debt ratio is lower compared to the company C. And another thing that I have to explain is like this. The situation is like this. Let's say you analyze 2 companies. Because you are an investor, you analyze 2 companies, you want to know which one is better. So let's say Company E, the debt ratio is 53%. Company F, the debt ratio is 59%. So, the question is, which company is better? The answer is both companies are not good, because both companies' debt ratio are higher than 50%. When the debt ratio is higher than 50%, you have to know that it is not a good situation. Always remember, debt ratio, if it is more than 50%, then it is not a good situation for a company or a business. Okay, remember this. The debt ratio, it measures the leverage of a business, and the formula is total liabilities over total asset. Okay, you want to do this, or you want to calculate debt ratio, you have to see the balance sheet. Okay, the second ratio that can be used to analyze financial statement is the current ratio. Current ratio is a measure of liquidity. Liquidity means how fast a company or a business can pay its debt, particularly the short term debt. Okay, current ratio, also called working capital ratio. If somebody asks you to calculate current ratio or working capital ratio, the formula is total current asset divided by total current liabilities. These two data also can be seen in a balance sheet, because a balance sheet contains a list of assets, liabilities, and equity. So you want to calculate this ratio, you have to check the balance sheet. So this current ratio, the higher the ratio, the better a business in terms of liquidity. If the ratio is low, it shows that the company has low ability to pay its debt or liabilities. Okay, so let's see the small yellow box here in the slide. Let's say business A liquidity ratio is 1.22 and business B is 1.75. Which one is better? The answer is business A. The higher the liquidity ratio, shows that the company or the business has a higher higher ability to pay its liabilities. So, like I said earlier, you can use the ratio to compare one business to another business, current year business data with previous year business data, and also you can compare the data of a business with the industry average. Just remember, the higher the ratio, the better the business in terms of its ability to pay debts or liabilities. Okay, another ratio, the third ratio that you have to know in this course is called the return on sales ratio. Remember, this ratio measures the amount of profit earned per dollar of sales. It is evaluated within the appropriate industry. So this ratio shows if a company makes $1 sales, how much profit the company can get from the sale. Okay, the formula is like this, very easy. The formula is net profit divided by sales. How to get these two numbers? How to get the net profit figure and sales figure? You have to check or to see the income statement, because in the income statement, the company has to list the the revenue, expenses, and profit or loss. So you check the income statement and you can do the ratio. You can do this ratio. So let's see. In the small yellow box here, business J liquidity ratio is 12%. So supposed to be business J return on sales ratio is 12%. And the market average of return on sales is 17%. So is this a good sign? Okay. The thing is like this. The business, or you do financial statement analysis for business J, and then you compare the return on sales ratio of business J with the industry average or market average. Maybe let's say business J is a service business. Is let's say the business J is a hotel. So when you want to compare with market average, you have to compare with the average of return on sales ratio of all hotels. So in this example, business J return on sales ratio is 12%. The average, market average is 17%. So is it a good sign? Can you say business J is good? No, it is not a good sign. For return on sales ratio, if the return on sales ratio is 12%, it shows that every $1 revenue made by the business J, the profit is 12 cents. So if business J got revenue $10,000, then the profit is $1,200. But the industry average is 17%. 17% means in the industry, for every $1 revenue, the profit is 17 cents. If the revenue is $10,000, the profit is 1,700. That is the market average. So business J perform below the market profit. So it shows that the business J is not good in terms of return on sales. Maybe business J is good in other aspect of business or of analysis. For example, maybe business J is good in debt ratio. The debt is low, but it is not good in return on sales. It can happen. Some businesses they have low debts, but their ability to generate profit also low. But other companies, they have high debts, but their profit or return on sales ratio is good. That thing can happen. So if you do financial statement analysis, this thing can happen. One business is good in one aspect, but not good in other aspects. If you read more or learn more about financial ratios, you will learn about how to interpret the data in more detail. Okay, let's see the next one. Another ratio that you have to learn is called asset turnover ratio. Okay, asset turnover ratio is a measure of company efficiency. It measures how good a business or a company do things in their operation. Some businesses, they are very efficient. They can do many things in short time. They can do a lot. Other companies, they can do not many things in a short time. So a company that can do many things or produce many things in a short time is an efficient company compared to company that can do less work in a time. Okay, so the higher the asset turnover ratio, the more efficient the company or the business in using its asset to generate sales. So the formula to calculate the asset turnover ratio is sales over total asset. Okay, you can see here sales over total asset. So how to calculate this? How to get the figure for this formula? Sales, you have to check the income statement, and then total asset. For total asset figure, you have to check the balance sheet. So let's say, see the small yellow box here. Business A asset turnover is 3.7 times. Business B is 2.8. Which one is better? Which one is more efficient? The answer is the higher the asset turnover ratio, the higher the efficiency of a business. So for this small yellow box, business A is better in terms of efficiency compared to business B. It shows that business A is better because business A has a higher asset turnover ratio. Let's say you analyze business A, but you analyze it by comparing the current year data with the previous year data. So, and then you calculate the ratio for business A. The asset turnover for year 2019 is 3.7. But asset turnover for year 2018 is 3.3. So, what is your conclusion? The business A is getting better in terms of efficiency or not getting better? So the answer is getting better, because business A asset turnover ratio for 2019 is higher compared to the business A asset turnover ratio in year 2018. So it shows there is an increase in the efficiency of the business. That is good. But if you see there is a decrease in the asset turnover ratio, then it is not good. It shows that the company getting less efficient. Okay. Okay, this is the next one. Return on equity ratio and its purpose. Okay, remember this. Return on equity ratio is an overall measure of performance. It shows profit earned per dollar of investment. Okay, remember this. Return on sales ratio shows profit earned for every dollar of sales. Here, for return on equity ratio, it shows the profit earned per dollar of investment. Dollar of investment means something like this. You are an investor. If you invest $1 in a company, how much profit you can get? That is profit earned per dollar of investment. The formula to calculate the return on equity is net income over owner's equity. If you are an investor, this ratio is very important because you want to invest money in a company. So you want to know how much profit you can get for every dollar of investment. So net income or net profit over owner's equity. Okay, how to get the figure for net income or net profit? It is coming from an income statement. How to get the figure for owner's equity? Remember, the owner's equity is listed in the balance sheet. So if you want to know the owner's equity of a business, you check the balance sheet. So, okay, see the yellow box here, small yellow box. Business A ROE, ROE is return on equity. Business A ROE is 23%. and business B ROE is 19%. Which business is better in terms of return of investment? So the answer is business A. For return on investment ratio, return on equity ratio, the higher the ratio, the better the business. The higher the ratio, it shows that the business return on investment is higher. So one thing about the ROE is, in accounting or in financial statement analysis, you remember this. See the second sentence in the slide. Typically, the ROE is between 15 and 25%. So remember this, if you want to invest in the business in the future, or you have to do financial statement analysis in the exam or in the test or anything, remember this, for return on equity, a business is good if the ROE is between 15 to 25%. If let's say you calculate ROE for a business, and then you found that the ROE is 10%. So the conclusion that you have to make is the company is not good in terms of return on equity. 10% is very low. If you invest in a company, you take risk. If the company collapse, you lost all your money or cash. So when you take risk, you have to expect high return. The higher the risk, the higher the return. So you invest, if you invest in a company or in a business, you have to, for the risk that you are taking, you have to expect that you want return from your investment or return from the equity is 15%, at least 15%. Below 15%, you better put your cash in the what they call this. There are many is investment fund out there. You can check public bank, investment fund, trust fund. Okay, trust fund. In Malaysia, the most popular trust fund is managed by public bank, I think. If you put your cash in the public bank trust fund, easily you can get 10% or more every month with low risk, very low risk. Okay, but if you invest directly in a company or in a business, that is high risk, because many things can happen to a company. Sometimes the company is good, but suddenly something happen and the company collapse and you can lose all your money. That's why if you invest in a company, see here the second sentence here, you have to invest in a company that has at least 15% return on equity, at least. Below that, it is not a good place to invest. And the second thing is 20%. The maximum is 20%. So ROE, for ROE, return on equity, a good place to invest, or a good business to invest, is a business that has ROE between 15 to 25. If you see that a company has ROE of more than 20%, then always remember this. In financial statement analysis or in accounting, the condition or the what they call this, the typical rule that we use is, if a business has ROE of more than 20%, it is also not a good place to invest, because most of the time a company that has more than 20%, more than 25% ROE, it's like too good to be true. That's the rule that we use in accounting. Most of the time, if the return is more than 25%, it is too good to be true. Maybe the company makes very high profit or return this year. Later, you will see that the company collapse. It is too good to be true. Many times this thing happen. Maybe it is a scam. Maybe in the future, let's say in the future, many years in the future, you have working, you have work, and then you have extra cash. You are planning to invest, and somebody comes. He said, invest in our company or invest in our scheme or anything. Our scheme ROE is 30%. So when you hear 30%, always remember, in accounting, if the return is more than 25%, most of the time, the investment is too good to be true. Most of the time, it is a scam or something that is not always happen. That is the general rule that we use in accounting. Okay, the last one is price earning ratio. This is for your general knowledge only, because in this course you have learned about accounting for a service business, sole proprietorship, service business. That is the thing that you learn in this course. This is very basic. Actually, if you for an accounting student, they will learn about accounting for sole proprietorship, and then they will learn about accounting for partnership, and then they will learn about how to do accounting for a company. Like I said earlier, sole proprietorship accounting is the simplest one, because the business is owned by one person, and most of the time the business is a small business. If you learn about accounting for partnership, it is complex. If you learn about accounting for companies, it is more complex, even more complex, because companies are mostly big businesses like Alibaba, Malaysian Airlines, AirAsia, Petronas. They are companies. They are very big business. They are very big businesses. They have thousands of, maybe millions of business transactions happen. Imagine. And then their assets are billions of dollars. Also, their liabilities are billion of dollars, and their equity also maybe can be million or billion of dollars. So imagine, very difficult, very complex to do accounting for companies. So this course focus on sole proprietorship business. And so for a sole proprietorship business, there is no share. Only companies have shares. Only companies sell shares. So the price earning ratio, this is useful for you in the future. Let's say in the future, you have extra cash, you want to purchase shares of a company. So one thing you can do before you purchase the share is you can do price earning ratio. The price earning ratio, the formula is market price per share divided by earning per share. So as far as I can remember, the lower the price earning ratio, the better. If a business has a low PE ratio, it shows that there is an opportunity for the business to grow in the future. That is as far as I can remember. So if you want to use this price earning ratio in the future, this is very useful. You can read more about this. Most, I think most, if not all, financial analysts will use PE ratio when they want to analyze a company and to make decision or suggestion whether it is a good place to invest or not. Okay, so this is the thing. So in this course, these 5, 1, 2, 3, 4, 5, 6. These 6 ratios is the ratios that you have to know, and you have to know how to calculate the ratios. And the second thing is you have to know how to interpret the ratios. You have to know if you compare two companies, which one is better. If you compare current year data with previous year data, so you have to know whether it is the business is getting better or getting worse. So this is just to refresh your memory about this ratio and the definition. So return on sales, what it is. Okay, see there. Asset turnover. And then assets to equity ratio, assets divided by the equity. And then profitability is the ability to generate income per sales dollar. Efficiency means the ability to generate sales through the use of asset. Leverage is using borrowed funds instead of invested funds. Okay, these are the ratios. There are 6 ratios, but you have to know 5. You have to focus on 5 ratios only. Debt ratio, current ratio, asset turnover, return on sales, return on equity. Price earning ratio is for your general knowledge. So like I said earlier, you have to know how to calculate every ratio. What is the formula for each ratio? And then second thing is you have to know how to interpret the number. So debt ratio, this is the formula. Current ratio, asset turnover, return on sales, return on equity, price earning ratio. Okay, like I said earlier, actually there are many methods that can be used to do financial statement analysis. In this topic, you have learned 3: horizontal analysis, vertical analysis, and ratio analysis. This is an example of another one, common size financial statement. If you have time, you can read this in textbook or other sources, how to do this method of financial statement analysis. Okay, so this is the last slide in this topic. What are the limitations of financial statement analysis? So, I have told you earlier why you have to do financial statement analysis. The basic idea is like this. You do financial statement analysis with 2 purposes: to identify problem of a company and to predict the future of a business. So the second thing that you have to know is, I have said earlier, you only can make good conclusion about a business after you do financial statement analysis. If you do not do a financial statement analysis, sometimes you see the company or the business is good, but after you do the financial statement analysis, you found that the company is actually not a good place to invest. So you can make a good conclusion only after you do financial statement analysis. Even though the basic idea is you can make a good conclusion after you do financial statement analysis, you have to weigh several factors here. Okay, first, financial statements do not contain all the information. All information is not numerical. Okay, point number 1 and 2 are related. When you do financial statement analysis, you know that you can make a good conclusion after you do the analysis, but you have to aware that not financial statement do not contain all information. All information is not numerical. Okay, sometimes when you do the financial statement analysis, let's say for company A, you do the financial statement analysis, you do the ratio analysis, for example, and then you conclude something. After you conclude something, you have to aware that financial statement do not contain all information. Sometimes the number says the company is good, but there are something else that is not included in the financial statement. For example, customer satisfaction, customer loyalty, location of the business. Maybe the number is good, but the customers of the business are not happy. So if the number is good but the customer are not happy, in the long term, the company will be getting worse, not getting better. So that is one thing you have to wear. Financial statement do not contain all information, especially the non-numerical info. Lack of comparison. Okay, there's the second point. Point number 2, 1 and 2 are related. So the next thing is lack of comparability between companies. So I have told you earlier, if you do financial statement analysis, you can compare company A and company B and make decision which company is better, A or B. So the way to compare the company is you have to make sure that the companies that you compare are coming from the same sector. So let's say you want to do analysis for oil and gas company. Let's say you want to do analysis for Petronas. You want to analyze financial statement of Petronas. So if you want to do financial statement analysis for Petronas, you can compare the Petronas analysis or ratio with other oil and gas companies like Shell, Petron, or what else? Caltex, and other oil and gas companies. You can compare with other companies in the same industry. Even though that is the logic, but after you make the comparison, always you have to aware that even though you compare one oil and gas company with another oil and gas company, but you have to aware that there are no two similar companies. Even though Petronas is an oil and gas company, and Shell also an oil and gas company, when you check the detail, they are very different companies. So always aware about that fact. There are no two similar companies to compare. The next point is not all problems are readily apparent. So this point also you have to aware. The point is like this. Sometimes you analyze a financial statement of a business and you found that everything is fine. Even though you see everything is fine, you have to aware that sometimes problems are not readily apparent. Sometimes the thing that can happen is like this. Sometimes a company is, everything is fine with a company today. When you do the analysis, you see everything is fine. But after several weeks or several months or even several days, the company can collapse. That thing can happen. Sometimes problems are not readily apparent. Maybe the company collapsed because of natural disaster. Maybe the company collapsed because of the company lost its major customer. So the company got lost substantial amount of revenue. So the company can collapse. Or the company involved in a scandal, something like this, something like Volkswagen. If you know about Volkswagen, several years ago, Volkswagen is a very good company. It can be a number one car maker in the world, and suddenly there is a scandal, something like the company in US, they found that the company declare something wrong with the carbon dioxide level from the car. So if you read about it, you will know. So when the company declare wrong data about the carbon dioxide produced by their car, the company has been sued by the US government or something, and they have their share price dropped very quickly, and the investors made big loss. So like I said earlier, problems sometimes are not readily apparent. When you check the financial statement, everything is okay, but after several days or maybe several weeks or maybe several months, suddenly the company is having a problem. Okay, the last point to aware is financial statement analysis is based on past performance. So when you do financial statement analysis, you have to aware that the number that you use to analyze, to do the analysis, is the past year number. Let's say you do the financial statement analysis now. Now it is 21st of December. But the best data that you have is the financial statement for the year 2019. Financial statement for the year 2020 is not ready yet, because the company will close its account at 31st of December. So like now it is one week before we finish year 2020. If you do financial statement analysis today, maybe the best data that you can get is the company's data for the year 2019. So you want to predict the future, but the data that you have is the past performance data. So you have to aware that you want to predict the future, but the data that you have is the thing that had happened. So it is not very good, but that is the only thing that you have. Thank you very much. This is the end of the lecture. I hope you can remember at least two limitations of financial statement analysis. The easiest one is the point number 1. Financial statement do not contain all information. It contains only numerical information. The second one maybe point number this one. Not all problems are readily apparent. You have to aware that when you do financial analysis, sometimes everything is fine, but later something can happen. It may be in the next several days, next several weeks, something happen, then the company can collapse. It can happen, and it had happened before. Okay, write your name and matric number in the comment section. I will take it as the attendance for today's lecture.